Hey everybody, we're going to do live DCFs. Just throw out a ticker and I'll run my model, see what the value of the company is. You don't have to donate. If you do donate, I'd appreciate it, but you don't have to. Let me know a ticker. Just throw it in the comments and I'll do it live. And please comment, even if you don't pick the ticker, let me know your thoughts on the stock. It's good to get some info. Para. Come on. James, what's up? Come on. Chipotle, expensive stock. They don't split. Paramount Global. I mean, this is a really quick and dirty way to do a DCF. I could do it in under 10 minutes, but obviously the more time you spend and the more analysis, in theory, you'll get more info. But sometimes when you overanalyze a company, you make worse decisions. So it's kind of, it's hard. It's hard to predict the future of a stock. I think not less is more, but you don't want to overanalyze. Sometimes you just keep questioning yourself and double guessing everything, and then you're like, you get lost in all the numbers. I guess trying to keep it simple. 30 up to 32. So right here, I'm just getting the future revenue projections. The company usually provides future revenue projections. Analysts do too. So this Simply Wall Street website is where I get it from. But you can get it from other sites. So it looks like by 2025, the company's projected to have 32 billion of revenue. So my model, I just have the next 3 years, 30, 31, 32. And if you do a ton of analysis and feel you think it's going to be 35 or maybe 25, put that in. Now I'm putting in the stock price. The market cap is 7.8 billion. Now I need the cash flow. So you could get this from Para seems failing to value, but I could be wrong. The thing is, if you want to buy a stock, you could find a dozen analysts saying, this is a good value, you have to buy. And if you want to short a stock or sell your stock, you could find a dozen analysts saying to sell, not buy it. So you could find on both sides. It's kind of like that with, what the hell happened? With like a food. If you really like to eat steak, you could find a ton of people saying steak is good. You could also find a ton of people saying steak is bad. So anything in life, you could find. I bought before for 550-ish. Nice, 550. So this is it is a little harder because I have negative free cash flow in the last 2 years. So it does kind of skew the results a bit. My model says 532. Let's just I think that's this most recent free cash flow of 1.1 billion. That really drags it down a lot. See, they had 1.1 billion free cash flow in the trailing 12 months. But negative free cash flow is not a terrible thing. If they invested a lot into, say, CapEx to try to grow grow their business. That may lead to significant growth in the future. 1.15. So in the past 4 years, they convert a little over 1% of their revenue into free cash flow. But you see, in the most recent year, it was negative 4%. So let's just take these first 2 years, which will be a 5%. That may be overly conservative. Let's just take away this most recent year. Let's just assume we're gonna use just the first 3 years to figure out. Okay, I think that's more realistic. 13.38. They're trading at $12. Hey Ed, what's up? Good to see you. And if you commented, haven't seen you in a while. I do appreciate those comments. It does motivate me. So I think 13 is the right range for the stock. So it's a little undervalued, but not too much. Abcellera I like a lot. It just keeps getting crushed, and I keep buying as it comes down. I'll tell you my so this is what so Abcellera in July 2021, I got 615 shares. God damn it. I got 615 shares at $16.21 each. Do what I say, not as I do, because obviously I'm not doing well with Abcellera, but it's one of my few negative positions. So, I mean, you can't win them all. Then in January 2022, I got 1,070 shares at $9.73. Then just recently, in June, I got 3,450 shares at $6.43. So I'm probably down like 50% on this investment. So my cost basis is $8.29. So I am bringing down my cost basis each time I buy. It just keeps going low, the stock, unfortunately. But I have time, and I'm probably down a ton. It's down to 442. So I could come down even more. I'm down 50%. Yeah, almost exactly 50%. So should I dollar cost average down again? It just gets scary when you keep plunking in money. I mean, 42K isn't like chump change. But you know, it's you risk, you invest, you risk. But like BRK, that's 525. I think in 2017 I bought BRK. I know I paid $262 for it. Wow, I'm almost exactly up 100% on BRK. 100.4%. So I mean, so this one stock, I'm up $260,000. So it makes up for these losses, but obviously that's my most profitable stock, BRK. Let's see. Okay, ET, I'm up a lot on that too. ET. I bought a bunch of stocks in January 2022, and most of them I'm down, except ET. I paid $864. What is that now? $12, ET? $13.46, even higher. So I'm at 56%. Plus, I've been getting dividends, so I'm probably up like 70% on that. Yeah, I think ET is pretty much always a buy. These midstream stocks are pretty safe investments. There's a lot less volatility on a midstream than an upstream stock. Upstream can be pretty volatile. So it takes timing. But yeah, I think it's a pretty safe. Because I mean, when you think of a midstream company, like ET, I mean, their main job is to move gas, oil or gas, from one destination to another. So they're just kind of like a transportation company. They do storage too. It's storage and transportation. So if an upstream company like BP drills oil and wants to move it from one location to another, whether by vessel or by pipeline, ET will just transport it. And obviously ET charges a fee to do that. So it's a lot safer for midstream companies because there's less risk. Because whether oil prices go up or down, it doesn't matter too much. Companies will need transportation, and it's not easy to transport oil. It's not like transporting phones or computers, or most products are pretty easy to transport. You don't need like special infrastructure or special know-how to transport like a couch. It's not too difficult. Just make sure it's wrapped and doesn't get dirty. But oil is just a whole nother animal. Earnings should be good this quarter too, with gas a bit higher. Yeah, well, gas prices have been going down, right? But I try to ignore that stuff. You can't really control like the noise in the market. Well, let's look at ET since somebody brought up ET. One of my favorite companies to invest in. 11.5%. ET. 384. Okay. Energy Transfer. They also own gas stations, ET. So they have downstream activity as well, and not just midstream. Look at that revenue growth. So when you see really big revenue growth, oh, when you see really significant revenue growth, 39 billion in 2020, so about 40 billion. So it went up about a double, like 110%. So that doesn't always, whether revenue goes up a lot, down a lot, or stay the same, that's just one part of the picture, right? If a company, if a company's revenue went from, revenue year one, so if a company's revenue went from 1 billion to 2 billion, that's 100% growth. So you might think, oh my God, that's great. This is a great company to invest in. And this company's revenue went down. It went down 20% from 1 billion to 800 million. Well, if company A spent like $5 billion in acquisitions, it's possible this revenue growth is bad. It should have gone up more, I'm saying, than 1 billion. And if this company maybe sold part of its business, or if it was in a cyclical industry, say they were in the gold industry, they mined gold, and gold prices went down like 40%. But their revenue went down 20%. So they're actually doing really well relative to the industry. So it's hard to look at just nominal numbers saying this is good because it went up, this is bad because it went down. It's not always true. It's kind of like if the market goes down 30% this year and your portfolio goes down 10%, you killed it. You did amazing. And if the market goes up 30% one year and your portfolio goes up 20%, you didn't do that great. You didn't even beat the market. Oh, let's get back to ET. So ET's $24. They're always undervalued. They're they generate so much revenue for the size of the company. But let's adjust the numbers a little. 11.5% WACC. Let's use what's the highest? 13.8. Let's use the highest WACC. So that brings down to 19. And the way the model works is we see what percent of their revenue they convert to free cash flow. So in 2020, they converted 6% of their revenue to free cash flow. 2021, 12%, 67 billion of revenue, 8 billion of cash flow. So in these past 4 years, they converted 8%, 8.2% of their revenue to free cash flow. But let's lower that a little. So let's just pretend they only do 7%. Be more conservative. It's still undervalued. So that's a good thing to do. If you stress the model a little bit, will they still be profitable? Because things don't go always perfectly as expected. If you own a grocery store and say inflation was 3% in prior years, and you're expecting inflation to stay at 3%, the way you do it, if inflation is 3%, your profit for running the store is $100,000. But you can't predict the future. You don't know. If inflation was 4%, your profit is $90,000. And inflation, like it is recently, like 7%, it's been crazy, you're break even. So like things don't always go perfectly as planned. So you might think, well, if inflation is high, like you own a grocery store, so you have to pay more for products, then just charge higher prices. Well, it takes time to do that. If you can predict prices will go up, you know next year what people are going to charge, what your vendors are going to charge you, then you could just turn around and charge your customers higher. It takes time to adjust to prices. You will adjust, but it could take a year or two. And so you might have a year or two with losses or you're struggling. What's got a potential multi-bagger for you to look at? LX, Sunoco, Embracer Group. Embracer, do you mean Embraer, the aircraft company? LX, can't really say that I'm familiar with this. Let's do the middle one, 12.8%. And what you should always do, it's a fintech. What you should always do is just learn what the company does. Hey, Asmin, thanks for the nice comments. Yeah, you should at least learn what they do. I think that's important. An online consumer finance platform. So the person that said Bulldog, everybody subscribe to Bulldog. Great guy. So are they do they provide loans? Is that what they do, this company? Provide like student loans, home loans? We are leading credit technology empowered personal finance service enabler. Our mission is to use technology and risk management expertise to make financing more for young generation consumers. So young generation, does that mean they provide, is it mainly personal loans? We strive to achieve the condition connecting institutions. So yeah, these companies, they connect like banks. So if you need a loan, you'll go through this company, and this company will go to a bank and provide them the parameters of the loan, your credit history, and then the bank will either approve or deny it. And this company takes like a fee, like a 1-2% fee for getting this done. Yeah, I don't know, fintech. I mean, there's nothing wrong with fintech companies. It's a good business model. It's just that they generally don't trade well. It's kind of like it's tobacco companies. It's like tobacco companies are such good companies because they provide a product that people are addicted to. But they don't. They always trade at a discount. So this is a Chinese fintech company, which makes it even more difficult because Chinese companies usually trade at a huge discount. And the country you're in, like, it's great if you're able to grow a business in any country, and most businesses are ethical businesses that are trying to make a profit for their investors, for themselves, and also provide a good product service. It's just unfortunate certain countries like Brazil, China, they just trade at a huge discount because of the country risk. So this is in Chinese yuan. So I just got to convert it. 14.8, 11.8 to 14.8. So let's just put the what's the yuan to US dollar rate? 0.14. So it's usually like 7. So if you see like, where is this? So 14, 15, let's just pretend it's 14 billion. 2025 revenue is 14 billion. Just divide by 7. So 2 billion US dollars. 12 to 15. I put the conversion here, so it does it. So 15 billion yuan equals 2.1 billion. I did spend a lot of time trying to figure out how to say the currency in China, even though it looks like yuan. The proper way to say it is it's kind of like WREN. It sounds close to yen, but it's yuan. And if you're Chinese, I'm pretty sure I did a lot of research on this one, so I think that's how you pronounce it. I could say yuan because that's, I think in America, they say yuan. Maybe I should just say yuan, but anyways, let's look at the future. That's another thing with non-US companies. Sometimes the data is not as complete as American companies have. The data is more kind of reliable, I guess you could say. And they have negative free cash flow most years. I'm at $1.47, but I don't know. It's really almost impossible. Yeah, this is a really hard one to predict. $1.47. That's probably not. It's kind of like it's like, how much is my house worth? Well, it's worth what someone's willing to pay. How much is my car worth? everything's always worth what someone's willing to pay. If whatever right now, people are willing to pay $13.46. So yeah, it's a little, banks, insurance companies, I probably would avoid. I don't want to value those. I'm not saying you shouldn't buy it, but it's really hard to value those. Let's do a valuable U.S. stock which you feel like buying. Yeah, Baba, that's a good one too. It's just, it doesn't it's still in the 80s. Yeah, I remember I bought it. I bought around the 80s, and then I was up a good amount. Then I was down. Yeah, it peaked at 307. I think I got it. Yeah, in 2022. I don't think I got it in the 80s. I think it was low 90s. I think I got it around this point, and then I was up. I was really happy. I don't know if I still hold it. I think I sold it. No, I think I have it. I got my 88 is my cost basis. 89.50. I mean, it's a great company. The more you pay, the more it's worth. That's true. It's like, I don't know if you guys collect baseball cards, but I remember when you know, a baseball card that was $500 in '93 is now $5 million. So if at an auction, if there's a baseball card and it's sold for $10,000 one year, and now it's auctioning, and just someone with really deep pockets is willing to pay $100,000, that's the new price. That's the value of the card. So whatever someone's willing to pay, and that drives the price way up. Yeah, Baba. Yeah, the Chinese government does make it difficult for companies to make a profit. But Alipay is really is where all the money comes from. Alipay is like PayPal, but is like China's version of PayPal. But they do like 20 times the amount of business PayPal does. They do so much business because they handle all the transactions for Alibaba. So that's where all the profits are, is Alipay. What's RH? Restoration Hardware. Okay. RH. So the 3.5 billion is the forecast for 2026. So 3 to 3.5. Does anybody invest in RH, Restoration Hardware? I think the first RH, the people who started RH are from my county. The first, well, it was called Restoration Hardware initially. The first one was pretty close to where I live when I started the company. 4.6 billion. Yeah, Corte Madera, which is a few towns over from where I live. I went to their roof. They have a rooftop restaurant, the RH rooftop. It's really nice, really upscale. So they're pretty profitable. Their revenue is going down. Do you know why the revenue is going down? They're only converting 8% of their revenue into free cash flow. It was up to 14% at one point. What if they got? That's what inflation really kills margins, as you can see. With not all companies, but some companies more than others. This company is obviously getting hurt. If they got back up to that 14% margin, then the stock is worth $283. Right now, in my model, it says they're converting 10% of their revenue into free cash flow. So if we just got rid of, let's just say it was 12%, which is still lower than prior years. Which is almost exactly where they're trading at. So this doesn't seem undervalued. It's kind of close. It does seem slightly overvalued, but I could see it going up probably in a couple of years. But I don't think there's that much room for growth anytime soon. Okay, I'll see you. Thanks for stopping in. BMY, Bristol Myers. It's a good company. BMY. Let's look at their future growth forecast. 47 billion. So from 45 to 47. Now let's look at their historical numbers. Pharmaceutical companies are pretty safe stocks to invest in. I mean, they sell a product that's highly needed. People sometimes, certain medications people can't live without. So I mean, when you sell a product that's saving lives, or people need it just to live longer or to feel better, that's generally a company you want to invest in. Let's give a little higher whack. Let's go to 8%. Even with a higher whack, you can see certain companies have much better margins. Like they're averaging 28% free cash flow margin. They convert 28% of their revenue into free cash flow the past 4 years. Other companies, like a car manufacturer or a grocery store, would have much lower margins than a pharmaceutical company. So this seems like it's pretty undervalued, 50% undervalued. PRZO. Para0. 7 million market cap. Aerospace and defense. They have less than $1 million of revenue. So they're pretty much pre-revenue. They don't really have any revenue. That can happen with a company like this. Such a small company, they can move a lot. They can be pretty volatile. PowerZero develops and provides state-of-the-art drone safety solutions that fuel the growth of the booming drone economy. So if you're if you want to get exposure to drones, I mean, this is a really risky stock. I mean, so it just IPO'd. We're October, so July 23rd, it started trading at 250. Unless you caught it down here, that's 76 cents. And probably only traded at that point for a few minutes. If you happen to catch it below $1, you should probably sell pretty quickly because it's going to come back down. I mean, why did it go up? Like, did something, they got a contract or something? Nothing in particular. I'm not buying anything. I did buy Disney. I thought that was a good value. I'm down probably 10% on that because I bought in like 86, I think. But PowerZero stock is rising on drone flight approval. That comes to the company's partner in Australia. See, a lot of times stocks go up like double or triple, not because they generated any revenue, just there is a better chance of them generating more revenue. Just like when the cannabis companies get closer to legalizing, when America says, oh, we're one step closer to legalizing cannabis on a federal level, all the cannabis stocks go up a lot. And then over the next few months, they go down, back down below to where they were. Yeah, Meta. Yeah. Wow, you bought at 98. So I had so much invested in Meta, and I was gonna buy a lot more at 90 when it went below 100, and I chickened out, and I kicked myself because I knew it was gonna go up a lot, but I just didn't know because I kept saying that when it hit 200. I mean, thank God my Meta stock is. Oh yeah, of course. Because I bought Meta the day they started trading. I bought them at 40. I remember I bought them at 40, and then the following month I was down 50, like not 50%, but almost 50%. It got maybe more than 50% because it got into the teens. And then I think I sold it. I was up like 300%, 400%. I didn't even sell it. I was selling call options. I was just making money in the options, and then my shares got called away because it went up too much. And then I bought it. And then I bought a lot. I think maybe like $70,000, $80,000 worth in May 2017. I got it for 151. So yeah, 151 in May 2017. And then July 2022. So in July 2022, where is that? Because I was up like over 100%. I think it was like 150% at my peak. And then I ran into some money. And then in July, I got it for, I know it was January. I got it for $335. It was $370 at a peak, and it was down like 10-20%. So I bought more. I bought a lot more. And then it kept going down and down. Every time it went down, I'm like, oh, it's 200. I should buy more. And I'm like, oh, it's 150. I should buy more. And I kept saying that. I mean, how do you know when to buy? I mean, and then it ran right back up. But it's a long-term hold. I'm going to hold that for a while. Yeah, James, I know. It's like even when you make money, we're never happy. Like I had like almost 200,000 into Meta, and at one point, because I was, I bought at 150, and then I doubled up when it hit 335. So if you combine it, like even when it fell at 200, I was still like break even when you combine my two investments. Then I was down like 30% overall at one point. So I was down like $50,000. I had $200,000 initially invested. I'm down 50,000. So it's hard. It was just hard to because I don't have like $50 million. So it was hard to put more into it, even though I'm pissed off I didn't put more into it when it fell below 100. But so we're never happy, no matter, even if we make money, we're just not happy. We could have made more. 88. Wow. Yeah. But even if you're confident of something, like I was so confident of Meta. I was so confident when it was over 300. I was like, this is my favorite. And I said that for forever on this channel. It's my favorite stock, my favorite company to invest in. Then when it fell below 200, I'm like, I still like it a lot. And then when it fell below 100, I'm like, it was hard for me to say this is the best stock to invest in. You lose hope, even though you know it's going to probably go up. There's that inkling in the back of your mind that like you never know for sure. But there's a lot of stocks like with Intel. I kept for years. I kept thinking it was going to go up, and it hasn't yet. I got it for like I mean it was like over $70, but that was over 20 years ago. And then it got back up to 70. Yeah, I think I got it for like, I don't know if I kept track of that one. No, I think I got it for like 50 or maybe 60. I can't remember. And I was up like 20%. And I'm like, okay, I'm smart. I know what I'm doing. And then I ended up selling around this point, losing down like 20% because I lost faith in the company. Best thing I can invest in is Indie Semiconductor. Indie. Yeah, it's a good semiconductor companies are good, generally good investments. Indeed. 500 million. Look at that growth. Sheesh. Small company. $877 million market cap. The revenue is growing a lot, but they have negative free cash flow, so it's a little hard to. So I'm going to assume they convert 10% of their revenue into free cash flow, so we can get a value. So I'm at 360. It doesn't seem like a great value, but I think the growth is built in. Oh, it was a SPAC because it started at $10. Yeah, it looks like a SPAC, right? It must be a SPAC. So $10, it got up to over 15. It was right around COVID. It came out. It did fall pretty low at one point, below $6 last year. It got up to 11. So it's really all over the place. Yeah, I try to avoid SPACs. Okay. I think Meta. I think there's a good chance. I mean, I've said it for a long time. I think Meta is going to be the first company to be 10 trillion market cap. I think with AI, it's going to really help because they do most of their money is from advertisements. Because even on the Facebook platform, that's where most of their advertising revenue comes from. Instagram too, but mostly on the Facebook platform because so many people. I think about half the world is on Facebook. So there's just so much. There's just so many people, so many eyes on it. Besides Google, it's the most used platform in the world, like the most users. Google has, I think, more people using their platform. But it's a little different, Google. Google makes a lot of money with ads too. That's where most of the revenue is, from ad revenue. But Facebook is so much more. Because there's just people, generally when I go to Google, like everyone else, I just search. If I want to search like how to make hard-boiled eggs. And then I find a website. So I don't really Google. I'm on it for like a minute, 2 minutes. Once I find a website, that's where I spend most of my time, on a website to like learn about what I want to learn about. Facebook, people spend, that's a destination. They just sit there, spend a lot of time there. In America, not as much as it used to be, but in other countries, Facebook is still growing. It's not like America is still a lot of people, but it's I think it's coming down there. The people in America who use Facebook. Sun for 10 years and holding for dividends, but it went up a share of the on these giants. Sun is just the gas stations, right? Is just the actual gas stations. The retail gas stations, the downstream part of their. Yeah, I don't get much love on my channel. It's not unfortunately, but any other stocks you want to do a DCF on? Let's see if anybody. Zim. I don't know if I can do Zim. Let's do Sunoco. We could do Zim, but it's such a volatile stock. Yeah, Sunoco is the 22 down to 20. $48, 4.1. Let's see. Yeah, some people got pissed off at me about Zim because they bought it and lost a lot. But I mean, just because I do a video doesn't mean I would buy the stock. I just do videos on companies people request, or if they pay for it, or if it gets a lot of views. You can see like their margins. You can see their margins are like they convert 2% of their revenue into free cash flow. So every company's different. It's industry specific. If you're a grocery store, you're not going to have margins above 5%. Definitely not above 10%. It's just not going to happen. You can't. But if you're if you sell software, you can have 50% margins. So it's really industry specific. So a company like this is not going to have huge margins. Their revenue will be high. Look at 23 billion of revenue. Even if you convert 2% of that into free cash flow, it's still 420 million. So it looks like the model's pretty much exactly where it's trading at. The model says 47, they're 48, so it's pretty. It doesn't. So if you were to buy this, even if it doesn't go up, you're going to get your dividend. And even if it goes down, you get your dividend, and you could just wait it out, wait a year or two, and collect 7%. But I mean, if these stocks go up, like you can see how like it was $56 in 2014, and then it fell. Well, it got real low. It fell to $15 during a COVID bottom. But if you could pick up the stock, and even if it's flat, you're probably going to get 7% dividend. But if the stock doubles, your dividend yield will be like 14% because you have a much lower cost basis than the people buying it today. Of course, if you buy it and it goes down, then your dividend yield is like 3-4% because your cost base is so much higher. But unless you pick it at the very wrong time, which a lot of people do, just wait it out. I'm sure people bought it in 2014. I bet you some will still have it by 2040. Grocery stores with above 10% are going to be burned down by the raging public. Yeah, I mean, no one would shop at if a grocery store was trying to make a 10% profit, no one would shop there. Everybody would go to a competitor because you couldn't survive. When you at a grocery store, you're selling so much product. That's why a 1-2% margin. Unless you're a specialty like a Whole Foods, or a little more specialized, you might be able to get a 3-4% margin. Okay, it's been an hour now. So yeah, thanks for joining. Sorry I didn't make a video in a few weeks. Kind of get lazy with this stuff, but okay, I'll talk to you soon. Leave a comment in this video or any video and let me know what ticket you want me to do next. Okay, thanks.